Good morning, everyone. Thank you for joining us on Morning Markets from True Potential. We start a new month, and today I thought I'd reflect back on some comments from last month, in particular sovereign bond markets, and then focus on the week ahead and what we expect. So just looking back over the month of February, really very much about what was happening in sovereign bond markets and how over the course of the month we saw yields moving higher in the sovereign bond market, and that really accelerating in the final week of the month. So last week in particular, we saw this very acutely with sovereign bond yields across the globe really moving quite extensively over the course of the week, driven by concerns about inflation expectations, but also I think to an extent market participants trying to see how central banks would react to some of this movement in yields. So if we think back as well, how did that play out in equity markets? Well, it really did support that cyclical rotation that we've been discussing over the past number of months. What did we see there? We saw the likes of the financial sector who benefit from a steeper yield curve. We saw the industrial sector, we saw energy, all being those sectors towards the forefront of performance last week. In contrast, those areas of the market that are reliant on higher growth, more of the longer duration assets, they suffered quite a bit over the course of last week, and we saw that how that interplay played out between, if we want to describe it as the new economy versus the old economy sectors over the course of the week. Indeed, if we look at overall how sovereign bond markets did perform over the course of last week, very much about really sort of hitting their peak level in terms of yields on Thursday, and then we did see them coming in a little bit over the course of Friday, so a bit of stability in sovereign bond markets as we ended the week. When we look at that over the course of the week, and even over a longer period, it's just worth looking at how steep the yield curve has become. And you can see that in the chart just on the screen at the moment. So what we're showing here is the spread between the 10 and the 2-year US Treasury. You can see back to 12 months ago, we had a very flat yield curve. We had 20 basis points difference between the yield levels across that different maturity, so between 10 and 2-year. Fast forward to today, and we've got a very different environment, and we've got a real steepness to the yield curve. We've got about 120 basis points of difference between the two yields, and that just is really the steepest, as you can see in the chart, that we've seen the yield curve for 12 months, but also just driving that chart back a little bit further, also the steepest we've seen in a good number of years. I think also last week we've touched on currency. Currency has very much been in focus, and really it's been about dollar weakness. Last week we saw that reversed, and we saw the dollar being stronger on a trade-weighted basis over the course of the week. Very much really working in terms of that safe haven status that's attached to the dollar, volatility in the bond market, volatility in the equity market, that attracting assets into dollar, and we saw a better performance of the dollar over the course of last week. Those currencies that had been strong and performing well against the dollar gave back some of those gains. So we did see sterling come back below the 140 level, ending the week at some 139. I think also the thing is really that we've continued to focus on market performance, but there's those other things that we've been talking about in terms of the lenses through which we look at the performance of asset markets. And really one of the things is to touch upon COVID-19 and really the speed of which vaccines are being rolled out. And you can see that in the following chart. So you can see there Israel well out in the lead, but then we've got United Arab Emirates and then the United Kingdom in third place there in terms of the speed of the rollout. That's very important to continue to monitor because it will feed into how economies are able to reopen, and in particular how the service side of economies are able to recover in coming months. Just then, turning to some economics, over the weekend we had the first part of President Biden's $1.9 trillion fiscal package being approved. So it was approved in the House of Representatives, now goes to the Senate for another round of scrutiny and discussion and debate. I do think there will be some trade-offs at that level as we're going through the Senate to get this approved. Ultimately, it looks to be approval by the 14th of March is what's being sought. the other point really to think about is just whether if the package in any way will be scaled back or the effect of it can be scaled back. One of the things that we discussed last week is how the scale of that fiscal support package is causing some concern about the outlook for inflation over the medium term. Looking then to the week ahead, what can we expect from economic data points that will influence how asset prices are moving? Very much in focus is going to be any commentary from central banks, be that from the US, be it from here in the UK, from the Bank of England, ECB, and then across the various different central banks in Asia, just given that magnitude of sovereign bond yield move that we saw last week, to see just the lay of the land, if you will, from central bankers. What are they taking from it? What do they say, and how do they discuss the move? We've already seen the RBA in Australia take some action just overnight, where they bought double what they would have normally bought, so 4 billion Aussie dollars versus 2 billion normally. And that has really had quite a significant impact on the 10-year yield in Australia, where it's moved back in from 185 to 166 over the course of the past number of hours. So again, that merits watching, because given the volatility that we've seen in Australian sovereign bond yields. The UK this week, we've the spring budget. There's been a lot of press speculation about over the weekend about what we might see. We'll leave that to the reporters. We'll wait till we see what comes out later in the week, and then we'll give some perspectives on that. Towards the end of the week, we've the US jobs report, which for the month of February, which will be an important indicator just to see that if that continued improvement that we've seen in some of the weekly numbers is feeding through into the monthly number for February. Just then, in Asia overnight, we've had some PMI data from China, both in services and manufacturing, both showing a little bit of weakness from last month, still remaining above 50, but we do have to think about the impact of the Lunar New Year holiday on that period. So there is some, I think, travelling and arriving in that, remain above 50, but at lower levels than that which we've seen over the past couple of months. I'll leave it there today, but please join us over the course of the week on Morning Markets. Many thanks.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.